we're going to be looking at certain scenarios and situations that give rise to certain behavioral issues. So in this particular model, we're going to look at the advisor-client relationship. This is like the central, area where behavioral issues are in play. What is the role of behavioral finance when it comes to the relationship between an investment advisor and the client? We're also going to look in this module at how behavioral traits affect portfolio construction. Think weights that your client will want to give to different asset classes and how that might affect the asset allocation process. So first up, the advisor-client relationship. How does behavioral finance affect the advisor-client process or the advisor-client interactions? Well, the whole point of all of this analysis is it's supposed to make this relationship stronger. It's supposed to make this relationship more successful. It's supposed to make this relationship more secure. It's supposed to help the advisor understand the client and to help the client understand what the advisor is telling them. All right, now that will lead to a longer term relationship which is more likely to succeed in meeting the goals of the investor. You might be in the position at the moment when you come across behavioral finance, if you're coming across it for the first time, you might sort of approach it with like the view that behavioral biases are bad and we need to just get rid of them. That's a little bit too strong. Behavioral biases affect the advisor-client relationship. They affect portfolio construction. We need to understand them and incorporate it into the decision-making process. And that should help us. Establish a more successful relationship. It should help the advisor understand the client's long-term goals and how important they are to the client. Okay, if we've classified the investor as risk-averse, emotional, then we understand that the primary goal will be preservation of capital. We don't necessarily say to them, you are exhibiting these biases and you are wrong. What we try and do is incorporate these behavioral biases into the process. And, in the end, the client has got these goals. In the end, the client has got these goals that they want to achieve, and our role is to help them to achieve them. Whether that's an optimal portfolio or otherwise, our role is to help the client meet their goals. We can always try and educate them, and with cognitive biases, that's likely to be successful. All right, more likely to be successful. With emotional biases, we might just try and adapt asset allocations to mitigate the effect of any biases that the investor has. But the whole point here is that through behavioral finance, we can understand, the advisor can understand, really get behind why the client is aiming to achieve, what they're aiming to achieve and why, and how important it is to them. It allows the manager to communicate back to the investor what advice they're giving and why it meets the client's goals. And this is very important. If the client understands what the advisor is telling them, the client won't get cold feet, the client won't decide to liquidate at the worst moment possible as soon as there's a few losses along the way. So it will help the advisor and the client together deal with short-term adversity in the process of meeting their long-term goals. So it helps with communication. That's really the upshot of these first 2 points here. It should also help the manager actually meet the client's expectations. It helps the manager to communicate the chances of meeting the client's expectations, plus what could go wrong, and how the client will expect to meet their goals, but if they understand why they don't, why they might not meet their goals, and what scenarios might lead to that, then once again the client's expectations are being fulfilled. Obviously they expect to meet their goals, but nothing unexpected happens with regards to a surprise to the client when it comes to meeting their objectives. And it benefits both the client and the manager. Don't forget that. Central to the whole idea is that it benefits both the client and the manager. It solidifies the relationship. It makes the relationship better, behavioral finance, because the advisor understands the client and the client understands what the advisor is telling them. And the other thing is, most clients, this is not just investment advice, this is anything. When you're the customer, you want a little bit more than just somebody asking how you want to pay for a certain good or service, don't you? You want a little bit more than that. You want a little bit more than just numerical results. Even if your advisor's bringing home for you the results that you were hoping for, meeting these goals, you'd want a little bit more treatment. You'd want to be treated a little bit more special than just being sent a report every so often and being, told that yes, we're meeting your goals. So it really helps through understanding the psychology of the client, because that's what behavioural finance is. It's understanding the psychology of the client. It really helps the client to feel that the advisor understands them, and it really helps when we feel like somebody that we're employing to do a service for us understands what we're trying to achieve, and gives us the feeling that there is a duty of care in the relationship. So it builds a strong bond, and it helps the manager build up a client base. Word of mouth, reputation, that sort of thing is central to an advisor's business. Now, very similar to what we were talking about in the last module, just be aware that these questionnaires that are used, a key focus of the learning outcome statement in this section is a focus on the limitations of these processes. So these questionnaires, we've touched upon a lot of these already, but the sorts of questionnaires that you might use to drill down on the client's behavioural investor type, these questionnaires, they can't be all-encompassing. Many types of questionnaires may overlook certain behavioural biases. The questionnaires tend to be better at identifying cognitive issues, that's more sort of mechanical, if you like, logical issues with processing information rather than emotional issues. And, when it comes to the type of client that is there in front of you, institutions tend to be bigger and more sophisticated, more professional, if you like. Individuals, they might just be somebody that's got no experience with finance apart from, this relationship that you have with them. They've got some savings, and outside of that, they don't know anything about markets. So there might be a little bit more emotion going on there. In terms of emotional biases at the individual level. You wouldn't likely see that at a sort of a professional sort of pension fund manager or sovereign wealth fund manager level. You need to do these questionnaires. Don't forget, one of the drawbacks of these processes is that investors' characteristics change over time. We do change over time as individuals, certainly. So you're going to need to redo these questionnaires over time. There are certain life events which have a profound effect on the psychological outlook of an investor, an individual particularly. Something like having children and having the responsibility of the next generation suddenly upon you, that can have a profound impact on your risk tolerance, whether you're active or passive. So you need to keep doing these questionnaires both over time as you get older and when circumstances change, like having children or getting married, or the reverse of getting married, breaking up, that sort of thing. How questions are framed in these questionnaires can lead to different results. It's a very common focus of institutions that set questionnaires. When you look at polling companies and things like that, they're very well versed in this idea that you have to be very careful how you frame a question, because people tend to have biases, either explicit, either conscious or subconscious. They tend to have biases where they might be more likely to pick the first option that's available. They might be more likely to agree rather than disagree, depending on how you frame a question. They're more likely to, go with something that is the status quo rather than go with something that is different. So variations in wordings on questions that are essentially asking the same thing can lead to different results. And don't forget, we did mention that people might give an answer that they think you want to hear as a setter of these questions rather than an answer that is generally truthful. The other thing is, you can't be too literal with the outputs of these questionnaires. If your client specifies that not losing money is one of the key objectives, then you shouldn't just go, okay, 100% cash, there you go, that's your portfolio. Next, don't be too literal with this. Clients are on a spectrum, all right, of different behavior types, and what you're really doing is integrating these ideas that come out of the questionnaire into a portfolio that is as efficient as possible, but also focused on meeting the client's objectives. All right, now the idea is, of course, that behavioural finance should help meet the client's goals and solidify the relationship. The other area where behavioural finance plays a crucial role is in portfolio construction. All right, so portfolio construction here is really setting the weights of your portfolio that are most likely to meet the client's objectives over the long term. So behavioural finance plays a crucial role here because it defines certain biases that particularly an individual might exhibit, which could lead to problems, really. And this is tapping into a lot of the traits that we saw in previous readings. Like, for example, that emotional trait of status quo bias. Status quo bias, you'll remember, is just sticking with what you've already got because you're lazy. You don't want to put in the effort, the psychological effort, the thought of going through the thought process of considering changing. So status quo bias, a classic application when it comes to portfolio weights, is not changing your initial portfolio weights. As an individual, particularly with your own personal pension fund, with an individual, you set out some weights that are relevant to you when you're 25, 30 years old, and you don't ever change them. You've still got those weights when you're 55 years old, which is not efficient. At 55 years old, you've got a lot less time to go to retirement, and so you should be a lot more risk averse with your investments because you can't afford to suffer large short-term losses. You haven't necessarily got the time to recover from them. So, you haven't got as much time to recover from them. So what's a way of dealing with this status quo bias where you never change your initial allocation? Classic with kind of defined contribution pension funds where people tend to manage their own allocation to different funds that the sponsor offers out. Well, you might say, do you know what, let's have a target date for our retirement. So maybe I'm going to retire when I'm 60, 65, hopefully, all right? And, if I specify that as a target date for retirement, then the provider of the funds can automatically adjust my risk, essentially adjust the risk of the fund, lower it down over time as I approach retirement. And that stops me from just sticking with my original allocation and having too much risk in my portfolio as I approach retirement, essentially. Another issue with portfolio construction is naive diversification. This is a non-scientific way of allocating to different asset classes. What you do is you just allocate the same amount to different asset classes or to different funds that are available. Once again, maybe in a defined contribution pension scheme where the individual gets to decide how they allocate their assets to different funds. There might be a growth fund, might be a domestic fund, an international fund, a bond fund, income fund. Naive diversification is where you avoid once again the pain of thinking. You just kind of go, well, if there's 10 funds, let's put 10% in each. Sounds about right. So that's a naive diversification. Conditional naive diversification is selecting a subset of funds and allocating equal percentages, maybe in a particular area. So maybe you'll pick maybe in equity you'll pick value, growth, large cap, small cap, and you allocate an equal percentage to that. Key thing is it's just for no scientific reason. It's an equal weighting to the different funds that are available. Often this is referred to as 1/n diversification. N for naive, that's a nice way of thinking about it. N is the number of funds, and what you're putting is 1/n in each fund. So if there's 10 funds, you put a 10th in each. 20 funds, you put a 20th in each, for example. So what other ways can behavioural traits affect portfolio construction, the weights that you hold in your portfolio? You might very well find that for retirement funds that can, you might very well find that whilst retirement funds show inertia, sticking with the status quo. So don't forget in the US, retirement funds are referred to as 401k accounts, okay, personal retirement funds. These are your personal pension schemes. Retail brokerage accounts, these are kind of like savings for retirement but are outside of your pension fund, where the investor might be trading a little bit more. These are observed to have high turnover plus regret avoidance. Regret avoidance which maybe leads investors to sell winners too early and hold on to losers too long, longer than they should. So, maybe we've got overconfidence here at the individual level when we've got a tradable account, not the pension, where we tend to know we're holding it long term and we might have inertia and status quo bias there. With the account that we can trade in, we can buy and sell in, we tend to be overconfident, maybe, and which leads to high turnover. And maybe we tend to sell our winners too early and hold on to our losers too long. Now, this part of the curriculum refers to that as regret avoidance. Now, a lot of you will be looking at that and maybe sort of an eyebrow will be up, because this whole idea of selling winners and holding losers too long in the previous section in behavioural finance was described as being due to loss aversion, okay, not regret aversion, which is a subtly different thing. And this is one of the reasons why I think delegates don't like level 3, is because of this, what looks contradictory, but actually it isn't. Both loss aversion and regret aversion could lead you to sell winners too early and hold on to losers. But for me, this particular part of the curriculum here is referring to it as regret avoidance. And what do I mean by that? Well, you're selling winners to avoid the regret that you'd have if you lost, if the winner reversed and you lost money, and you're holding on to losers. You're not crystallizing the loss because you'd regret it too much. I know that previously in behavioural finance, this was referred to, selling winners too early and holding on to losers too long, this was referred to as the disposition effect, and that was a result of loss aversion, where we hate losing more than we like winning. The key thing is you could justify that selling winners too early and holding on to losers, you could justify that is a result of regret avoidance, or it's a result of loss aversion. My personal advice is that in the exam, they won't mix those two together, all right? If there is somebody holding on to winners too long, selling winners too early, then loss aversion is likely to be the only option that you can pick in a list of traits that are out there. The CFA Institute, they know that there is this kind of fuzziness about this part of the curriculum, and you should not worry that they'll use it against you. My advice to you is that you know very well that if you like selling winners too early and holding on to losers, my advice to you is you go into the exam and you think of that as an application of loss aversion. That would be my advice to you, because that is the key application of loss aversion. Okay? However, you could justify that it's an application of regret aversion as well, as we just said here. Now, that aside, this excessive trading too much, it could be just self-selection. It could be selection bias, and that is that people that tend to hold retail brokerage accounts, they tend to be active traders and they tend to trade too much, whereas other active traders that don't feel they need to trade so much, they'll just be happy putting all of their savings or more of their savings into the more restrictive pension plans, 401ks. Now, another issue on portfolio weights that's to do with behavioural finance is home bias. This is to do with really to do with familiarity. All right, so it's kind of an extension of that. We do tend to find that individuals will be overweight their domestic market, and that's simply because they're more familiar with their domestic market. So, people in the UK, if the UK has, represents 10% of world market cap or whatever it does in terms of listed equity, you'll tend to find that people in the UK will hold a lot more than 10% UK allocation in their portfolios, simply because they're biased towards their home market. They feel like they are more familiar with their home market, right? Just a feeling, emotional feeling. You could also use familiarity to justify excessive concentration in employer's stock. You feel like you're familiar with your employer, so you feel more comfortable holding your employer. Or, this is another thing we see with portfolio weights, is to overweight your employer. Now, this is a very nasty thing, because if your employer goes under, like if you're a travel firm and you wake up one day and they've said we haven't got any more money, and that leaves everyone up in the air or on holiday for longer than they expected, for example. If you work for that company and you've got a lot of your investments with that company, this is really bad news for you, because your investments have gone to zero and you've lost your job. So this is really pernicious. This is really potentially nasty when you have too big a weighting in your employer's stock. And that does tend to be a feature of individual portfolios. Why? Well, they feel familiar with their company because they work there, so they feel a little bit more at ease, more comfortable holding a bigger position. They might be overconfident that their role at the company gives them an insight, and so they feel that they are more knowledgeable. So they're overconfident with regards to their ability to predict the company's fortunes. If the company's been doing well, they might naively extrapolate that it's going to keep doing well. It's another reason to be overconfident. That doesn't necessarily just apply to your employer, it could apply to any investment, but that's another reason that might compound your weighting your employer here. Plus status quo, and also framing. If your employer gives you stock as part of your compensation package, you might consider that an endorsement of the stock. Or if your pension plan provider makes a matching contribution to your pension plan in company stock, you might consider it an endorsement of your company's stock, which it isn't. They're just giving you, a contribution to your pension plan in company stock. So there is this problem that when you say to somebody, these are your options, or you give something to somebody, they actually take it as partly like a recommendation, like you've recommended it, when maybe actually you haven't. Maybe your company, your employer hasn't recommended their own stock as much as you think they have. You may be loyal to your employer, and that might flow through and cause you to hold on longer than you might think. You might think it's disloyal to sell stock in your employer because you still work for them. Maybe that is an irrational extension of loyalty. Maybe that goes a bit too far. Also, you build up a big position because maybe your employer, through share saving schemes or contributions to pension plans, maybe they give you a discounted price on your employer's stock, and that leads you to favour buying it rather than any other security. All right, so behavioural portfolio theory here really has helped us to understand how the portfolio construction and the advisor relationship, the advisor-client relationship, can be impacted or improved. Don't forget, right back at the start, reading 7, so the first reading, we did meet behavioural portfolio theory, BPT, as an alternative to modern portfolio theory, Harry Markowitz's modern portfolio theory. Behavioural portfolio theory, we've already met this was in reading 7. It's just a restatement that actually we can use our knowledge of behavioural traits like mental accounting, segmenting our portfolio into different parts with different risk objectives. We can use that to build up a layered portfolio and actually segment the portfolio into different parts that we're going to use to meet different goals with different risk objectives. This is something we've met already. It's a key part of your level 3. It was called Behavioural Portfolio Theory in reading 7. It's mentioned again here. And when you're building a portfolio where each layer is focused on your client's goals, later on, this is going to be referred to as goals-based investing when we're talking about asset allocation. So this is crucial. I would wager it's something that is very likely to feature when it comes to your exam. So make sure you're on top of that. This is actually an application of behavioural finance integrating into the process where you segment. You're saying, okay, this is what they're doing, so let's go along with it. Segment the portfolio up into layers, maybe a really sort of safe layer at the bottom to meet core needs, and then a little bit more risk to kind of generate risk market returns, sort of risk premiums coming from general markets, and then an aspirational layer where we're going to try and get richer. This comes up in individual advice later, asset allocation later, so make sure you're okay with this general idea. In summary here, it's important that you're able to briefly describe why behavioural finance improves the advisor-client relationship, and really, with regards to the kind of jargon that's being defined here, make sure you can define the jargon points that have come up: home bias, status quo bias, naive diversification, and you're good for this module.